thank you for participating in the CalPERS update, how we got here and what's next. My name is Christina George, and I am the Education and Events Manager for the League of California Cities. And first things first, I wanted to start us off with some housekeeping notes for today. This session is being recorded. Attendees are muted. However, the question and answer is available throughout the entire webinar today. And following the presentation, the recording will be shared with all attendees. So just a reminder on how to ask a question. I know you all are pretty familiar with this. However, I wanted to remind you that in order to write in a question, you can select the question and answer button on your toolbar, and you can also upvote questions with that thumbs up button, and that will bring the most popular questions to the top of the question and answer screen. That way our moderator as well as our presenters today can know what you are most wanting to hear about. Alrighty, for our speakers today, Cindy Silva is our League of California Cities President and Council Member from the City of Walnut Creek. She'll kick it off in just a few moments. We also have Carolyn Coleman, who will be closing us out today. She is our Executive Director and CEO of the League of California Cities. Our moderator today is Lainey Milstein. She is the Assistant City Manager for the City of Sacramento, past President of our Fiscal Officers Department at the League of California Cities, too. And our presenters, I know you know them well, Marcy Frost, our CalPERS Chief Executive Officer, and Lisa Middleton, Council Member from the City of Palm Springs and CalPERS Board of Administration. So before we jump to our presenters today, I'm going to turn it over to the fabulous Cal Cities President, Cindy Silva.
Thanks, Christina, and good afternoon, city officials. Thank you for taking the time out of your busy schedules to participate in today's webinar, which delves into one of the most challenging issues that our cities face, the long-term sustainability of our California public employee retirement system, which we know as CalPERS. Today's webinar is very timely in that the CalPERS Board of Directors will consider a possible adjustment to the CalPERS discount rate at its upcoming board meeting in November. And our cities know only too well, a lowering of the discount rate will likely increase city pension costs and could significantly impact our already stretched budgets. That's why Cal Cities is advocating against a lowering of the discount rate at this time. Today's webinar will give us a better understanding of the statewide retirement issues, how we got here, the current challenges, and the future prospects for employer rates. Joining us today are three experts in these issues: CalPERS CEO Marcy Frost, Sacramento Assistant City Manager Lainey Milstein, and Palm Springs City Council Member Lisa Middleton, who in her spare time serves as a member of the CalPERS Board, where she is a strong voice for our cities. I want to thank all three of you for being here today. Marcy, I in particular want to thank you for your willingness to meet with us prior to your November board meeting. And I want to assure you that regardless of the outcome of that meeting, Cal Cities remains committed to working with CalPERS to find balanced solutions that both safeguard retirement security and ensure that local governments have the resources we need to continue to deliver high quality services. City officials, I encourage you to take full advantage of this session and to be ready to ask the most difficult questions. And with that, it is my pleasure to welcome today's moderator, Sacramento Assistant City Manager, Lainey Milstein. Lainey?
Thank you, Cindy. Good afternoon, everyone. We are so glad that you've joined us today. I'm going to be moderating our Q&A, and like Cindy, I really encourage you to ask the questions. Now is the time. We have a captive audience and experts in this field, so it's really to your benefit to ask the questions that you've been dying to ask. We're very fortunate today to have Lisa Middleton and Marcy Frost here to share their insights on the issues the CalPERS board will be considering next month that will no doubt affect the bottom line of nearly every city in California. As you're well aware, labor is the largest cost driver for local government, and along with salary adjustments, CalPERS costs are the second largest driver of city costs for the programs and services that we deliver to our residents. I look forward to hearing from our panelists as well as your questions as we navigate the changes necessary to ensure the health and sustainability of the pension system in balance with rising pension costs and the effects on employer affordability. At this time, I'd like to turn it over to Lisa and Marcy for their presentation.
Yes, thank you. And good morning or good afternoon, everyone. And this is the second opportunity that I've had the privilege of talking about the current state of CalPERS to many of our public employers. It's something I know I enjoy quite, in my day, as well as Ms. Middleton. So next slide, please. I think it's good to start with the funded status and some of the metrics and scorecard pieces of data that we track very closely here at CalPERS. Our assets under management grew significantly with our 21.3% net of fees return. Currently, actually a little more than the $469 billion that you see on this slide. But what that actually means is we're getting closer to being fully funded. And we know that that fully funded means that the employers are paying a little bit more, as we've had to make some pretty significant decisions around our financial policies, including the discount rate, including the amortization period, just as two examples. The 82% funded status assumes that the 7% return target is still in place. And as many of you know and have since realized, if you've attended one of our other webinars that we've done on what we call our ALM cycle, which is the asset liability management cycle that we do every 4 years with an every 2-year check-in, that the risk mitigation policy, which I'll go into some detail on later in the slides, has, because of the excess return of over 9%, because the risk mitigation policy is in effect when it's 200 basis points above the assumed rate of return. So anything above 9% has an impact on decreasing the discount rate. So in this case, with the 21.3% return, it decreased the 7% discount rate automatically to 6.8. Now, the funded status is one of those numbers that there is a bit of debate about what is the right number. And, in our perspective or our viewpoint, we know that our members, including our employer community, pays close attention to the funds available to pay long-term benefits. And it adds to the confidence that people have in the system, the trust that the decisions that are necessary for the long-term sustainability of the fund are being made appropriately today. So this number means a lot to the 2 million members, as well as our 3,000 participating employers. So we moved out of that red zone. When I first started, we were roughly 68% funded back in 2016. When the discount rate was moved from 7.5 down to 7%. We now sit in that more or less yellow zone at the 80% funded. That is, significant progress, but that progress did not come without some financial impacts to all of primarily our public employers. Anything above the 90% is the right zone to be in. We're not saying that we have to be specifically spot on with all the actuarial assumptions at 100%, but anything above the 90%, we believe gives us a little bit more breathing room in the type of risk that we take in the portfolio. We can afford a little more volatility in the markets when we are in a healthier funded status. Bouncing back just real quickly to that 21.3, again, that is net of all fees. And we had a 4.7% in the last fiscal year. And I will spend a little bit of time talking about drawdown risk policies, including the risk mitigation policy that was put into effect in 2015, when we were roughly 64% funded. The concerns at that time about a market drawdown that would move the fund from 64 to below 50%. And a fund of our size with a liability stream that we have, it'd be very difficult to recover from a less than 50% funded status. So there were certain policies that were put in place that essentially shaved a little bit off on the high performance, but protected us on the downside. So that 4.7%, what you would have seen in comparing us to what people call our peers, benchmarking to our peers, we were top decile performance at that 4.7 because we had a little bit of risk taken off the table versus our last fiscal year at 21.3, we're probably closer to the middle of the pack relative to our peers. Next slide, please. So investment returns, as you all know, extremely important to the way that we pay benefits. I don't have a picture of the pension buck here, but roughly 60 cents of every pension dollar that's paid is done through the earnings on the contributions and the earnings on investment returns over time. The 30-year, as you can see, is above 8.4. The 20-year number is the only number that is less than the assumed rate of return or the growth rate, and that's because the 2008-2009 financial crisis is still reflected in that 20-year number. But you'll see for all significant reporting periods that it is above the 7% discount rate, including the 10-year, which I believe 10 years ago we were at 8% as our assumption. And I'll just invite Lisa, whether on the last two slides, Lisa, whether there was anything that you would like to add, and we can go back if you'd like.
Not on this specific slide yet, but
okay.
The next one.
All right, next slide, please.
All right.
So when we talk about risk and return, and this slide, even though it's quite difficult to see all of the time reporting periods, but essentially what this slide is indicating is that in order to hit our assumed rate of return, we could invest in a very low risk strategy, primarily through, the 10-year treasury was essentially meeting the assumed rate of return or the growth rate that was expected on the fund. But you see what happened is that black dotted line, and then the white dotted line just kind of follow along, that's the discount rate. But the treasury rate was sufficient to cover all of the, the growth assets or the growth needed on the portfolio. But you see what happened to that treasury rate over time. So as the treasury rate came down, the blue area, highlighted area, is the higher risk assets. So as that treasury rate came down, we started investing in higher risk assets to keep that discount rate fairly stable. And that's the effect that you see in some of the market volatility, which you can also see reflected here. And that's, essentially moving from, this risk-free rate, which is where our discount rate was over 20 years ago, compared to where it is today. We are very high on the risk spectrum and a significant exposure to those growth assets, including listed companies and public equity, private equity, that we take on a pretty significant amount of risk in the portfolio to keep that discount rate or that assumed growth rate stable. Lisa, I know there was something here you would like to add.
Yeah, there are a few things. And Marcy, thank you. And I want to thank everyone who is participating today. One of the commitments that we've made is we're going to make ourselves more visible and more available to you so that we're answering your questions as best we possibly can, and being clear and transparent about what it is that are the decisions moving forward that we need to make. So this chart's a bit busy, but it's got an incredible amount of really important information. And if you read from the bottom in number of years, when we get to the year 2000, we had approximately a 10 to 15 year very high rate of return. The rolling 10-year rate of return was all in every single year was above 10%. Funded status in 2000 was sitting at 121% funded status. We were still seeing treasury bills that were paying a respectable rate. I don't think anyone in 2000 was predicting that treasury bills 2 decades later would be sitting at basically zero. And the legislature, with a tremendous amount of urging from a number of individuals, changed the benefit calculations for state employees and made it possible for municipal counties and other government entities to change their benefit design. And those changes substantially increased the benefits that were going to our employees, It also was predicted at the time that it would have relatively modest to no impact in terms of cost. That just simply didn't pan out whatsoever. It has had a dramatic increase in cost. And in 2012, legislature came back, made changes, and now we have the PEPRA defined benefits, which will over time substantially help employers in terms of costs. But there is a cost arc associated with all of the employees that were on payroll during those years from 2000 through 2013 that are going to be long lasting for every employer. Those are decisions we made. We're the ones that made the decision to increase the benefits. Now, there were very strong competitive reasons for why we did so, but the impact on the system is one that is something that is incredibly profound. As we move forward, one of the things that I think is very clear from this chart and looking at some of the previous ones, the future is in fact unpredictable. And we are going to be consulting with all of our experts we have for over the last year to try to identify what is the right mix of risk and reward for us to have going forward. But the idea that you can achieve 7% rate of return without taking on risk is simply not something that is possible. Now, the issue becomes, and what we're going to be talking about over the course of the rest of this presentation, and very fundamentally, the Board of Administration is going to be debating in November, what is the right, acceptable, reasonable level of risk for us to take to get a responsible rate of return. Next slide.
So at CalPERS, risk is amongst us, as Lisa indicates, and we have to determine, which of these risks are the highest priority and make sure that we have the utility and risk mitigation plans in place to address them. So investment risk, as Lisa just mentioned, you can't achieve a 7% return without taking on an equal amount of risk. So there's no such thing as this high return, low risk. It's really balanced, and we have to balance it in a prudent way. And what we think our investment office either has the utility to do in-house, or we have the expertise and the ability to have outside managers come in and help us to run a strategy. But that investment risk is the number one risk to the system, because it does contribute to both of the second and third risk on this slide as well. When we don't meet that return target, we know that that increases the unfunded actuarial liability. And for the most part, by a large majority, we know that the public employers are the ones paying that part of the cost to fund the pension plan. So the board will be looking at a number of candidate portfolios. Our team will be walking the board through any trade-offs. These are all about trade-off decisions and what we think realistically how we'll be able to enter the market, and whether that can happen over, essentially this 20-year time period that we look at every 2 years. The sustainability side, we get a lot of questions on sustainability and ESG, and to what extent did decisions of past boards around divestment, how did those factor into the funded status or the amount of assets that we have available for investment. And our approach to sustainability and ESG has been a term, some people love it, some people not as much, but we define ESG as really sustainability of the fund. And in order for the fund to be sustainable, to pay pensions over decades, over generations, we need companies moving alongside us that are also thinking about long-term risks and long-term issues related to their sustainability as a company. That's frankly how we have defined this, and our approach is pretty matter of fact and practical. We've got an advocacy role where we make sure that there's a level playing field in the markets, that we give better transparency about carbon emissions out of companies or human capital issues or board governance issues, which is more the traditional way of defining ESG. But it's not about divesting from, an asset or a company that we don't like for, for other reasons. If we have the data, that's the first step in this, is we have to have the data being transparently reported to institutional investors like CalPERS so that we can make an investment decision. These are not divestment decisions. So Climate Action 100 Plus is the way, it's our primary way of engaging with companies on the climate side of sustainability. And we've made a commitment to be carbon neutral by 2050. And we've made that commitment not through divestment, but through engagement. And Climate Action 100 Plus is our primary engagement with companies. There is $55 trillion in assets behind that initiative that we co-founded. And they have been, we've seen some work at Exxon, we've seen some work at BP, we've seen some really significant progress being made here by these private engagements. These are not public engagements. It's not about publicly shaming a company for not doing something we asked for. These are about private engagements to get us the data we need to make the right decisions moving forward to that 2050. On the human capital side, this is around the way that companies treat their workers. It's about making sure that companies are thinking about the workforce and the talent that they're able to recruit and retain. We're seeing that now with supply chain shortages. We're seeing that now with really workforce shortages throughout the supply chain. That's been a little bit of a hit on the markets. We know that is causing some inflationary adjustments to be made. Those are all dynamics in the market and the economic environment where we have to operate. Those are things that we consistently watch for. And then on the governance side, that we use our proxy voting, our voice there to make sure that the companies are really thinking about board governance, about board diversity, about ethics, the things that will really get a company in trouble if they're not really thoughtful and thinking about it over a long period of time. So we spend a lot of time with sustainability, not because we're going to divest from a particular company that's not doing what we're asking for, but because we know that we have to look at it from the risk side and the return side. Now, frankly, we don't see a lot of opportunities yet on the return side, although 20% of our private assets are now invested in more green investments that we believe have the ability to get us the return that we need, but that's 20% of the private side. And then on the public side, it's really about this engagement and transparency so that we can make better decisions around that particular company or that particular asset. And then employer affordability, Lisa speaks about this at our board meetings all the time. She is the voice for the public employers. She's not the only voice, but I'd say she's the strongest and loudest voice on this topic. As we were looking at candidate portfolios in September, there were constant reminders about employer affordability, that sustainability of a defined benefit plan has to have the employer's ability to pay for those benefits as a primary factor to decisions. That also meets our fiduciary responsibility to those 2 million members. So Lisa, is there anything here you would like to add?
I think you said things very well, but I know from my city, we don't want to be talking about CalPERS. We want to be making decisions as to whether or not we're going to hire additional police officers, firefighters, what streets we're going to pave, and what parks we're going to build. But the costs are incredibly high. I think there is reason to believe that if you look out 20 years, when PEPR really starts to kick in, that cost arc will be heading in a very positive direction. But those of us who are elected officials know that 20 weeks is a long time in politics, much less 20 years. The issues around sustainability, though, are something that I think we all need to step back and take time with. We've seen an awful lot of folks come forward and talk to us in terms of what has been the investment returns for this particular industry or that particular industry over the last few years. What we never know, what we don't know from that analysis is what's going to be the rate of return over the prospective number of years. And those are the decisions that investment teams have to make. One of the things that I hear frequently from individuals is this belief that somehow or another CalPERS returns have been dramatically affected by the degree of divestment for political reasons that have been taken on by CalPERS. It's been something over 5-6 years since we made a divestment decision. The most leading divestment decisions that we've made over time were to not invest in tobacco, in firearms manufacturing and distribution, and thermal coal. Those decisions were made, were difficult ones. They were made years ago. In more recent years, we have been consistently asked to not invest in fossil fuels by one group of individuals, by another group of individuals who have been asked not to invest in China. And in each case, we're making decisions based on what is good for the system moving forward. When it comes to Chinese investments, we rely on what are the recommendations and the prohibitions issued by the United States State Department. And I think that's a reliable place to turn to when it comes to a question of where should we not be investing moving forward. The staff in our investment office work incredibly hard trying to assess where is the market today and where is it going. Thank you. I think we can go to the next slide.
So this slide is a good place for us to talk about that drawdown risk and the candidate portfolios that we'll be showing you here in just a few moments. It's the trade-off. It's the balancing of the risk and the potential reward with a lot of assumptions around the future around those rewards. And what we're seeing in the capital markets as we were preparing the candidate portfolios is that all the forward-looking returns across all of our asset classes are muted. They've come down. So we've had a large run up in the markets over the last 15 years. The equity markets have performed pretty well, and most people believe that will be adjusted. And the timing of that adjustment is what market timers always try to do. We don't try to time the markets. We're not good at it, and the impact of timing them incorrectly is too impactful. But this is what we're always trying to balance is in these portfolios. We know that the private assets and including some of the emerging markets, Lisa mentioned the investments in China. I can let you know we are legally invested. Every asset we own is done in a legal way. We follow the Office of Foreign Asset Control. When they delisted certain companies, we immediately took capital out of those particular companies. So we're completely legal, but there are a set of markets. The U.S. growth, frankly, is not enough to get our 6.8 to 7%. We have to look at emerging markets, of which China is part of that market, and they're in our index. The China A shares are in the index, and that tends to be where we get a lot of conversation or a lot of questions. And we appreciate questions because it gives us a real opportunity to sit down and talk with our stakeholders and our board and others about the why of the way that we invest. But the percentage of the private assets, we do get some individuals who private markets can frankly be what I call a little noisy, whether it's a buyout fund, which we've been overly concentrated in buyout funds over the last 20 years in private equity. And we need to fix that. We did a 20-year look back at our private equity portfolio. That was one of the findings, that we were overly concentrated in the buyout funds. And if there is noise around private market, it's usually around net employment growth. It's around the way that a particular GP is handling the workforce or handling the way that they're funding the ongoing benefits or pay for those employees during the restructure or the rebuild. But the percentage of private assets are extremely important as we think about the current portfolio today is sitting really at 6.25. And those capital market assumptions that I mentioned that are muted as we look forward, 4 years ago, those capital market assumptions said our current portfolio could project to produce 7% over a 20-year time period. With the new capital market assumptions, that same portfolio is projected to return 6.25 over the next 20 years. So even though we call this the risk mitigation policy, we actually have to take on more risk to get from 6.25 to 6.8. And that's really what we're working the board through. What's the trade-off? What risk are you willing to take to move that 6.25 reward up to a 6.8 reward? And private assets will be a part of that. Now, I know some of you tracked AB 386 during the last legislative cycle. That bill did not make it out of the Senate Judiciary Committee for some questions that we'll need to go back and address this next year. We will bring this back to the board. We believe that it is additive to get a 5% allocation to private debt or private credit. We started calling that direct lending just to make it more understandable to people who don't operate on the investment side or don't follow CalPERS as much as this audience does. The other part, because we are increasing our allocations to equity, whether that's public equity or private equity, the percentage of leverage on the portfolio was really intended to diversify that equity exposure. That's, again, another drawdown risk mitigation. And that policy or that viewpoint, even at 80%, is still something we need to be aware of and make very informed decisions about to what level does drawdown risk continue to factor in as we look at these portfolios. And then the volatility, market volatility. The markets will be volatile. We expect, some form of volatility. Most of these candidate portfolios range from an 8 to 13% volatility. And again, that ties directly into our tolerance for that drawdown. And so I'll pause there before we go to the candidate portfolios to see if Lisa would like to add anything here.
What I would add is from a Board of Administration standpoint, our responsibility is making determinations as to how we're going to allocate the assets that we have under investment to various classes. We're not sitting down and making a decision as to whether or not we're going to invest in stock A or stock B. Those are decisions that are made by our wonderful staff. And what we're going to be getting into in the upcoming slides is really that specific question. What should our asset allocations be? What can we expect as a rate of return for each one of those classes? And how do we arrive at getting the right mix of asset classes and percentage of allocation to each class to have a responsible rate of return? And with that, I'm going to let Marcy walk through some of the candidate portfolios that were presented to the board at the last meeting and the ones that we asked to come back for further discussion at our November meeting.
Thank you, Lisa. And feel free to add anything as I'm going through these. Another fairly busy slide. I had my glasses on so that I could go through it as well. But this particular portfolio, and we call them candidate portfolios because these are candidates for consideration for the board to make a decision. So candidate portfolio C, a little bit higher on the risk and return, a little more diversified. So this one has a discount rate of 6.75, which in November's meeting, you'll see that this discount rate has been adjusted. So it's 6.8 to the projected return of 6.8. The time horizon, again, is 20 years. Drawdown risk, 22.9% with 11.8% volatility. And we have a view in the markets that we think the shorter term is going to be, and we have a view on the shorter term versus the longer term. So what this is intended to illustrate is that we believe in the near term is probably 5 years out, that the projected return is 6.2, and then longer term, when you extend it out the full 20 years, that we believe that we would see a 7% return with a 22% drawdown risk and 11.6% volatility. And that 11.6 is pretty much within the range that the board has always approved. So this would be, higher returns in our current portfolio, which I indicated sits today as 6.25 because of those muted or reduced forward-looking capital market assumptions. And let me just explain real quickly, the capital market assumptions look at, we have 15 contributors, so asset managers, money managers around the world are contributing their views on the market over this 20-year period of time. So what do they think public equity is going to return? What do they think private equity, fixed income, real estate, real assets, opportunistic credit, what do they think over the next 20 years? What's their professional view? Because remember, we're all looking into the future and using our judgment on what we think will happen. So we have a survey that goes out every quarter. We have 15 contributors to that survey. JP Morgan, Hamilton Lane would be a couple that might make some sense to all of you. BlackRock is in there. And we take all of their view. We contribute a view to it as well, the board, and we typically try to find that middle point, that middle view. So this portfolio we expect would, even with those reduced capital market assumptions, would produce that 675 over 20 years. So, the cons, we're trying to work the board through the trade-offs that they would be considering. We would have to have additional private asset deployment to move from the 6.25 to the 6.75. The policy changes typically would range around the board's delegation on individual private equity deals and the amount that the team is delegated to do without board approval. We likely, because of the fund size that would be necessary to increase to the 6.75% portfolio, we may need a little more delegated authority than what we have today for private equity deals. There is some increased exposure to ESG issues, but I'm really happy to, and just thrilled to report, public markets have been a place where institutional investors have been able to have their say, either through the SEC or directly through proxy voting. And we've not, other than our own GP-LP, limited partner agreement, and that's where the governance rights and the fee structures are all negotiated, we really haven't had a standardized way of reporting out on certain metrics that are important to an investor like CalPERS. So we can ask a public company to give us greenhouse gas emissions or, workers' comp injuries or net employment rates. And we never really had access and coalescence around that with the GP community. And, frankly, a single limited partner like CalPERS, we've been a little bit hesitant about putting additional demands on the GPs in the private equity space, just, concerned that they could do LP shopping. They could go to another limited partner, Washington State or Wisconsin, a Texas Teachers, a South Dakota system that may not have those same constraints on the relationship. So this needs to be done as a community of LPs and frankly, a community of GPs. So we just launched a new set of metrics, and we were the co-founder along with Carlyle, which is a private equity company. And we have 181 GPs signed up to report these metrics to CalPERS and other LPs. So it's really interesting work, and we're thrilled that we've been able to make that progress in our private equity or private market space. So even though we would have some additional exposure to ESG issues, we believe that some of that can be tracked and followed in decisions around allocation of capital now that we would have more of a standardized set of measurements. And this one, higher contribution and funding risk compared to portfolio A in the current portfolio. And so, you can see in the middle, this is how, the various assets would be deployed. The yellow is real assets. You've got an allocation of 5% to private debt, which I mentioned. And so I'll pause there and see if Lisa wants to add anything on this particular portfolio.
Marcy,
and Lainey, yeah.
We've had a couple of questions, and I think it's important to go back to, because this is so complicated to define or redefine drawdown risk.
Yeah.
If that's
possible.
So
drawdown risk is what is the board's appetite, right, as the decision maker. Drawdown risk is when the markets, so what happened in 08, 09, the markets had a significant drawdown, right? And we've seen a little bit of drawdown in the last couple of weeks, but it's when the markets, really go into the red zone. And what we have is a diversified portfolio. That diversification is extremely important so that all of these asset classes that you see in the middle they don't act to those market conditions in the same way. Drawdown risk, because we're so exposed to the equity markets themselves, when the market takes a bit of a tank, if you will, how concerned are we about that, where we put more diversifying assets in that may not give us the same level of return, but also shaving off a little bit of that higher performance when the markets perform better than what we would expect. So because of the funded status, we've had a policy and a position and a posture that drawdown risk is much more important to us. When the markets tank, we want to insulate from the bottom a little more than shaving off a little bit on the top. And the illustration, I think, of that has been the last 2 years' returns for CalPERS. So the 2019 return of being 4.7, we were top decile performance. We got a 4.7. Most of our peers got a 3% because they were fully exposed. They did not have this drawdown risk measures in place to the extent that CalPERS has them in place. It's not that they didn't have any, we just had them at a higher degree. So we're much more concerned about the markets really tanking and protecting ourselves from that bottom of the market than we were, again, of shaving off a little bit at the very top of the market. So that 4.7 was top decile performance, where most of our peers got a 3% return. We got a 4.7 return because we insulated ourselves between that 3 and that 4.7 by having these diversified assets. The 21.3% return, when you see individuals getting a 25% return, that's because we shaved off a little bit of that time of that return between the 21.3 and the 25. And again, those were intentional decisions that were made back in 2015, that this is the way that we want to insulate the portfolio, that it's asymmetrical risk, right? We're much more concerned about drawdown than we were about the outperformance, that we wouldn't be able to capture all of that outperformance.
As we know, markets go up and they go down. Over time, anyone will tell you that if you stay in the market, you will succeed. But one of the big issues consistently for an organization like CalPERS is when the market is going down, do we have cash on hand to meet our obligations? And that's part of making sure that we diversify the portfolio that we have and diversify it with a sense that markets are going to go down. Now, it was a short-term drop last year at the start of COVID, but the second quarter of 2020, the market dropped tremendously. And we were actually in a position, because we had diversified the portfolio properly, that when prices were low, we were able to buy some stocks at a very attractive price. That did not happen in 2008 when the market crashed. We had to sell at the worst possible time. So this issue around what is the drawdown risk is, in my simple terms, just simply, how are you protecting yourself when the market does have the drop that markets are going to have over time before they return back up, and protecting yourself from those. But if I could add one thing to this particular slide, it calls for an increase in an allocation of investments to private assets or private equity. Over the last 10 years, private equity has returned over 11.5%. It has had a very good return for us, and that's why we're interested in placing more money in private equity. But one of the things for all of us in the public sector that we have to recognize as we start to invest more in this market is, one, headline risk goes up when you're involved in private equity. And two, success in the private equity market is like success in any other, except maybe a little more so. You really do have to make a long-term commitment that you're going to be in that market and work through it through both the ups and the downs. And it requires incredibly talented management and leadership to be involved in the private equity market. This is not buying a T-bill. This is something that really requires top-notch talent in terms of the management of the portfolio.
I can talk a little bit more if the audience is interested in what we've been doing with the private equity program. I mentioned that we had done the 20-year look back, and there were a couple of things that we found. In addition to we were overly concentrated in the buyout funds, we also had stopped our co-investment program, and that's where we can have, we can eliminate a lot of the fee drag. The other criticism of private equity is that the fees are significant, and they are. But 20%, that 20% carry fee, I'm not saying that we pay 20%, but that's the 2 and 20, if you hear that term, is done when the fund outperforms. And so, the system I came from, if the fund does well, the GP does well, the LP usually does well as well. But the co-investment program, by stopping that, it really put all of the fees into the fund of funds, as we call them. And so our policy target of private equity, even at the 7% from 4 years ago, was to get 8% of the portfolio invested in private equity. We were not able to do that for a very long period of time for a number of reasons that we have since learned a lot about. And part of this, the co-investment program, the separately managed account program, getting set up, getting the right team in place at CalPERS. We have a new managing investment director there as well. But we were down 6.3%. So if private equity is your highest performing asset class, which for CalPERS has been, it had a 43.8% return last fiscal year at 6.5% of the portfolio. A lot of the funds that outperformed CalPERS this last fiscal year had a much higher allocation of private equity. So if you're 10% private equity in your portfolio to our 6.5%, obviously the returns are going to be better. So the policy target of 8% was just recently hit, and that's really credit to the team of working through the relationships that we have with the top performing GPs. There's a wide dispersion in returns between the GP community, which is why Lisa indicates it's a tricky relationship business in private equity, and so we believe that those relationships are back on the right path. The right path meaning they need to work for CalPERS as well as they need to work for the GP. But we're already, I think we're at about 8.3% at the policy target, just a little bit above the policy target. We have a +2, -2 that the board has given us for a policy range. But you'll see, as Lisa indicated, you'll see that this allocation would take that 8% policy target to 13. And that's why I spent a lot of time talking about private equity. It's an asset class I know pretty well. We've got a very, very strong team in place right now, and they have conviction that they can get 13% of the portfolio working to our favor. Next slide, please. So this portfolio is similar to candidate portfolio C. It will also have the discount rate of 6.8, the projected return of 6.8. What's different about this one is it's got the 5% leverage. And so what you'll see in the pros is in the long term, there's much more diversification than candidate portfolio C, which gives us a little bit smoother ride. You'll see the volatility numbers come down. The long term is 11.1. And then the cons is just that more complexity of having, describing how leverage is working, figuring out the right time to lever, and we would lever at the portfolio level. There's some leverage already within the various asset classes, some of the private asset classes in particular. But the difference between C and D is really this addition of 5% leverage at the total fund. Next slide, please. So candidate portfolio E, this would be if the board chooses to not allow the risk mitigation policy to stay in effect and make a decision that they want to return to the 7% discount rate, 7% growth rate, that this is a way that the allocation across those various asset classes would work. And at that point in time, it must have 5% leverage for that diversification, because we would have way too much equity exposure, and that drawdown risk would be a real problem for the fund. Back to liquidity, back to the ability to pay benefits. So this is the highest projected return at that 7%. We didn't think it was prudent to put anything else out there above 7 on that risk spectrum. This is pretty far out there already. The highest discount rate of any of the candidate portfolios, and also obviously would have the lowest projected contributions. The cons of this one, as I indicated, it would require the 5% leverage at the total fund level, the private asset deployment, the same policy changes I already referenced, and then the higher portfolio contribution and funding risk compared to portfolio A, as well as the current portfolio. But I think the leverage, there are a lot of questions about leverage out there. We need to spend a little more time in November doing an education session on how leverage would be implemented, why we believe it's necessary not to boost returns, but to diversify the significant equity exposure that we would have. And we will be doing that with the board. We can certainly do it with the stakeholders to the extent that there's demand for it. Lisa?
The big issue that's here is the one we've been talking about, and that is how much risk we're willing to take on. And this is a portfolio that gets us to a estimated 7% rate of return. That's certainly attractive to all of us that don't want to see a change in what we're paying for the retirement programs today. And for so many cities, it's absolutely an essential budget issue. As we project forward with this, though, we have to very seriously look at what is the risks that's associated with the portfolio. Is it manageable? And as all of us read the headlines today, we're entering into a time of some uncertainty in the financial markets. And that's a time when it is worthwhile to be prudent and cautious as we move forward. One of the things about the asset liability process that we're coming to a conclusion on for this cycle in November, it's a 4-year cycle, and we will continually look at what our projections are going to be and try to make the best assessments moving forward. We're not afraid to come back and revisit this if we need to.
And we do have a 2-year check-in on these 4-year cycles. And the reason, part of the decision-making process here, there are 2 costs to the system, right? So there's the normal cost of what does this benefit formula cost on a longer term, and that's the contribution rate to fund the benefit design. The unfunded liability side is where our actuarial assumptions have not proven to be true. And so all of those additional costs get moved over to what I call the unfunded liability bucket, of which, again, most of the public employers are paying that. So this decision is so important that we get as close as possible to what we think we can get from the markets, because if we're wrong, it adds to that unfunded liability, and then you're paying that 6.8 or 6 or 7% on that debt. So it's much better to pay it in the normal cost. You're not paying the additional 7%. Much better to pay it and factor it into the normal cost of the plan, and hopefully continue to reduce that unfunded liability.
So let me add to that. One of the things that is involved in this process is consulting not only with the investment professionals, but our actuaries. And they're having to make decisions based on their professional judgments as to what is responsible and reasonable. So board member may decide, I'd love to have a target of X, whatever that may be. If it cannot be a target that an actuary can, in their best professional judgment, take and sign their name to, then that's not a responsible target for us to take and choose. So we're really looking to be as prudent and as responsible as we can be moving forward.
Next slide, please. And the only other item I would mention is that the board also asked for a 6.5% portfolio to be brought back. And so we will bring that back. And I think as well as the current portfolio, there wasn't a lot of coalescence around the current portfolio sitting at 6.25, but I think it was because the 6.5 was missing from the candidate portfolios. I think the board would just like an opportunity to do a quick review on that before a final decision is made in November. Along with November, all of those contribution rates associated with each one of those candidate portfolios will be available. We'll have all of that material out just as soon as we can so that you all can start reviewing it and seeing the impacts to your particular cities. And so opportunities for additional stakeholder engagement. We've inserted a number of webinars. We just completed the 4th webinar with employers yesterday. It was pretty well attended. There were about 300 unique entities who attended that session. And that one was facilitated by Michael Cohen, our Chief Financial Officer, Scott Toronto, our Chief Actuary, and then Sterling Gunn, who runs asset allocation in our investment office. And I think more of the questions though were really around leverage. What does that mean? Which candidate portfolio did they view the board was leaning more toward, which obviously we don't answer that, but I think the policy being at 6.8, we have to take a heavy look at 6.8, and the real decision on the 6.8 is levered or unlevered. And so November, you'll get all the experience study results, which feed into the demographic assumptions around salary growth and new entry and retirements. You'll get the economic assumptions, so that's inflation and the discount rate is a couple of examples. And then we'll discuss all the candidate portfolios again that we were asked to bring back with their associated discount rates. Adoption of those new actuarial assumptions will happen in the Finance and Administration Committee, as well as the economic assumptions, the final approval of the discount rate, and then final approval of the strategic asset allocation, i.e. candidate portfolio. And then July 2022 is the effective date of all of those decisions that will be made in November.
So the November meeting is November 15, 16, and 17. We are planning to reconvene in person back in Sacramento. There is going to be an opportunity for significant public comment, and we look forward to hearing from everyone. My email address is Lisa, L-I-S-A, Middleton, M-I-D-D-L-E-T-O-N @palmspringsca.gov. Please feel welcome to reach out to me in advance of the November board meeting, and I will make sure that your comments are shared with everyone on the board, and I'll ask the good folks at the Cal Cities to include my email address to everyone who's participated in this. It is incredibly important that we hear from employers as a part of this process. Thank you.
Thank you both for your presentation this afternoon. It is a lot of information. We have several questions that have come in through the chat. It's interesting, I have learned about the Elevate button. So one has risen to the top. It's a fairly long question, and so I'm going to go ahead and share that with you. It's around the UAL and the repayment amortization change to 20 years, making UAL potentially more volatile based on future gains and losses. And the question is, why aren't we talking about both normal and UAL costs? It seems we're very focused on the discount rate and normal cost and ignoring the potential for volatility to our UAL payments that exponentially outweigh what our normal cost is. So the question is, do we need to be talking about UAL methodology as much as the discount rate? or given that the UAL assumes the discount rate that is ultimately adopted, does that sort of mitigate the volatility as we lower it?
Yeah, so the 20-year amortization, when that was put in place, was only for future gains and losses. And so the 21.3% return will have a net positive effect on that 20-year amortization. So your rates will come down. Also, if the 6.8 stays in effect, you're not paying 7% on that unfunded liability, you're now paying 6.8. Mm-hmm. The 6.8, however, on the normal cost, because you are expected to not get 7%, right? It's reduced to 6.8, the normal cost would come up. And that's where I think we're getting a lot of questions about what does that mean for PEPRA members. PEPRA members, the way that their contribution rates are calculated, there is a banking mechanism, and this could be enough of an increase with the banked amounts already in place that would trigger a rate increase for employees and not just for employers. And so this is all of the information that we'll be giving out in November.
I think that's a great segue too. So there is a pension outlook calculator that's available to all of us today. And the next question is, when will that calculator be updated to reflect the board decisions on the discount rate and the impact of the ALM study?
Okay, so I saw that one come in, so I did check in with our actuary. So he says the current version does let users change the discount rate to 6.8 or something else, whatever you prefer, but it does allow you to do it to 6.8, and then also reflects the risk mitigation policy. You just need to put in the 21.3% return, and then that will calculate your contribution rates. It does have the latest 2020 numbers, so all the 2020 valuations have been uploaded to that database. And then once the board makes a decision, then the team will start working to get that pension outlook tool updated so that the default is the 6.8. Okay, but you have the ability to do that with the 2020 data already being uploaded.
So great. So everybody has the ability to do that right now. It's just making sure you put in the 21.3 and then setting it to 6.8. And you can play with all of the different candidate options should you want to see how that affects your contributions.
You got it.
So here's an interesting question, and I want to encourage folks, please make sure that you're looking at your actuarial reports, because not every program is 80% funded. I know in the city of Sacramento, we're well below 80%. This is the fund in and of itself. So the question is, isn't over 80% funded status a good thing? So the discount rate should stay the same.
80% is better than 68. It's probably the best way to describe that. It's not where we need to be. Drawdown risk is still a concern for us, but it is a good number. But Lainey's point is a really important one. Not every public employer of the 3,000 is at 80%. That's the average. So some are better, obviously, and some are worse. I would prefer that number, get up into closer to 90% before we would look at not necessarily lowering the discount rate, but keeping the discount rate static. Now, the risk mitigation policy is still in effect, and it's not a vote by the board for every year's performance. It basically says if you outperform, so 6.8, so if you outperform anything in excess of 8.8, we'll continue to lower this discount rate unless the board takes an action to negate it.
I could add on funded status. Cities spend a lot of time comparing themselves one to another in terms of what their funded status may be, and it can be terribly misleading. If you're going to make a comparison, try to compare yourself to other municipalities that are like you. Do you have full service police and fire within your portfolio of employees? Because if you do not have police or fire, you are incurring far less costs than other cities are who do have police and fire. Also, how old a city are you, and how many legacy employees do you have that are in your system that were employed between 2000 and 2012 before PEPRA kicked in? It's really important to take a look, not just how many employees do you have in your workforce today, but what's the total number of members in the CalPERS system, which will include not only how many you've got on payroll today, but all of those that are in your retirement programs.
Thank you. Really important things to understand when you're comparing your pension obligations to that of another city. So this seems to be a popular question because I heard it at Cal Cities, and I also heard the answer is, what's the CalPERS position on cities issuing pension obligation bonds?
And that question has come up a number of times for us. And we have not taken a position on pension obligation bonds. We believe that the public employers are in a far better place to determine whether a POB makes sense for them or not. We have seen some activity in this area. We are certainly here to support you in helping you to make that decision of what that might look like in the future for your rates. And under various scenarios, our actuaries are happy to help you make that decision. But we really have not taken a position on POBs.
And what I can add, and I will do this, my own personal judgment based on what I've experienced both at CalPERS and in my own city. Pension obligation bonds are not a silver bullet. They're appropriate under some circumstances, not under others. What you're doing in taking on a pension obligation bond is assuming additional debt. And you need to make a real good judgment as to whether or not additional debt is something that is right for your city. I would encourage any city considering it to consider all of your options before proceeding, and make sure you're hearing from individuals who are going to be both supportive and skeptical of pension obligation bonds. Then make your best judgment.
Thank you. It's always a sticky question. We have a question around asset classification, and again, sort of that politically charged notion of ESGs, et cetera. And, local government feels like it's in our best interest to hit that rate of return versus addressing these social and political causes. And so, how do you address our desire and your desire for a sustainable pension fund with the political pressure that happens for these types of decisions? You touched on it a little bit, and there's just a little further clarification asked.
Thank you. Yeah, it's a really good question. These large public pension plans have been somewhat politicized over time. I can talk about my CalPERS experience since I've been here. I just 5 years on October 3rd. And as Lisa indicated, we've not taken a new divestment decision. We really have gotten quite clear. The board is clear. We're clear about our role in sustainable markets, sustainable companies, and sustainable investments. And that means we need to keep our chair at the table. We need to keep our voice active. The moment you divest, you lose your voice, and it doesn't really matter what you say or do. And then the only option you have is to continue to divest. And so we have, I think, mutually agreed upon expectations between the board and us about the way that we want to execute our sustainable investing strategy. And as long as it's in alignment with our investment beliefs and we're seeing real progress being made, of which I think we are, we report out on our ESG 5-year plan. We just reported that out in the spring. We'll continue, with an annual report out to the board to show the progress that we really are making. But we believe we have a role here, and that role means we have to stay engaged. We have to stay at the table. It doesn't mean that we're not going to continue to see the pressure that we have, both the topics Lisa mentioned around investments in China, investments in fossil fuels. We'll continue to see that kind of pressure, but we have a fiduciary duty to pay benefits. That's the fiduciary duty of the board. It's my fiduciary duty. It's the fiduciary duty of the investment office. And that fiduciary duty does not include, someone's personal political views. It has to actually have, a calculus that says, even though, fossil fuel companies may be performing well or not well today, what's the trajectory or the projection of that asset over the next 10 to 20 years? And it's delicate. It's probably one of the most difficult things that we do is trying to explain to very passionate people about why we can't divest from certain things, and not just those two. We get pressured to divest from other types of companies. Palm oil was a recent one that came to our attention. But we can't divest from all of these markets and still expect to hit that 6.8% return and expect to pay these benefits. So we've been able to withstand the pressure by engaging with our stakeholders, sitting down and explaining the data that we're using to make the decisions we are. And so far, at least over the last 5 years or so, that seems to be effective. We have a path to 2050. That path is policy and regulatory change. It is advocacy, engagement, and then integration. And we have integrated a lot of ESG opportunities, again, into our private assets. And hopefully we'll be able to see more of that as these public companies are transitioning into cleaner technology. And that's the purpose of our engagement program. But if we're seeing that they're not managing their risk, and we don't believe that that company will be sustainable over our 20-year investment horizon, then we'll use the data and we'll make a capital allocation decision, meaning we may not put capital into that company. But that's not divestment. That's not our definition of divestment.
Thank you, Marcy. Lisa, did you have something to add?
Let me add a couple of things to that. Remember, we're a $470 billion investor. We're invested in the world market. We are responsible for providing benefits to over 2 million CalPERS beneficiaries. We don't have the ability to simply write off large sectors of where investments are made and have the kind of diversification and rate of return that are going to allow us to produce the benefits that are needed to pay those benefits to 2 million people. But the ESG strategies that we put in place, I think, are ones also that are working to influence corporate behavior. CalPERS was one of the leading investors that was responsible for pushing for alternative choices to the ExxonMobil board of directors, and 2 individuals who are committed to addressing long-term climate change issues were elected in the last year to ExxonMobil's board of directors, and they would not be there but for the influence that CalPERS and other like institutional investors had in pushing forward for those strategies. That is, I think, the map for us in the future.
It's interesting. This is one of those times where, the folks who are promoting divestment of a particular issue are very vocal at the CalPERS board. And this is also a place, we are shareholders in this $470 billion fund. And so I think it's incumbent upon us to participate in the process as well, for them to hear our voices. And I have a question around that. And commenter says, definitely getting information as early as possible is helpful. But for the board meetings, you've mentioned a 3-day board meeting. When there are opportunities for local government input, it would be really helpful to get more clarity on when during the day or the meeting speaking opportunities will be. And Lisa, very much appreciate your offer to filter those through your email. But the question, it says a time certain would be most helpful. And might that be an opportunity, given the enormity of the decision that we're asking the board to make, to share with folks like those on the call about when it would be best to tune in or to be available to provide comment?
That is something that I would like to see us be able to do at this board meeting, is to identify a specific block of time that we can do that. But it's a very busy schedule that we have over the course of 3 days. And I know Marcy has heard this comment, and I'm hopeful in sitting down and working with the schedule and with staff and with our president that we're able to identify that specific time.
Yeah, and we have done time certain agenda items in the past on whether those are administrative law decisions. But this is a really important decision that the board will be making. And so, yeah, give me, Lisa and I can sit down with Henry, but I don't see why we wouldn't be able to accommodate a time certain on either the candidate portfolio, probably less than, Finance and Admin Committee, I think, is where I've gotten more requests from public employers for time certain agenda items. So let me take a look at that and bring it back.
Much appreciated. Thank you. I'm going to switch gears for a second. I have two questions on investment. So one is, can you define buyout funds for our listeners? And then, will CalPERS invest in rental property development?
So buyout funds are, essentially, it's a public company public companies, because in a buyout fund, you have a number of companies. So the way that private equity fundraising happens is the private equity owner, the general partner, will go out and do fundraising with all of the various limited partners. And basically they say, we're raising a fund. This is a buyout type of fund, meaning likely they're taking a public company and they're taking it private and they're going to rebuild that company. And typically in a rebuild, they believe that its resources need to be minimized in some way, restructure of accounting systems, restructure of management, operational or manufacturing improvements, which sometimes leads to fewer employees. So that's really the nature of a buyout. They're buying a public company, taking it private for a period of time. And, essentially what we've seen is that more public companies have been taken private over the last 15 years, and they're staying private longer. So what's called an initial public offering, IPO, typically after they sit in the private equity fund, typically 3 to 5 years to rebuild that company, and then they do an IPO and put it back out. That 3 to 5 years is extending into much longer holds. So that's what a buyout fund is. But again, not enough diversification in our private equity program. And there are all kinds of other funds. There's venture funds. There are, funds that are what we call separately managed accounts or co-investments, where we sit alongside the GP and they have a view on a particular sector. So there'd be sector funds, maybe focused at healthcare, focused at technology. But we were overly concentrated in that buyout, which is really a rebuild, break down and rebuild a company. And then rental properties, I'm not certain what our real estate team is looking at there. I'll take a look at it to see if we're seeing any deal flow there. I don't really have the access to that information right now.
Okay, so I'm going to ask one more investment question, because this popped up and it's so right on the edge here. Why hasn't the investments looked into acquiring crypto assets?
Crypto is one of those, currency risks that we look at, and we would not take an active bet on currency. But I don't know if you saw recently that Jamie Dimon, he certainly has a view on crypto, but he also knows that there's a significant demand for it. And so they will make it as clean, I think he called it, as clean as possible, which then would give exposure to investors like CalPERS. But we would only do that passively through our benchmarks or through our index providers. We would not do that as an active call or an active risk bet that we think crypto has, some ability to be material to returns. That's not our view.
Thank you. I think there are a couple of questions associated with drawdown risk, which we've already talked a little bit about. And I'm wondering if there are materials available that we can send out to our participants, because it is such kind of a deep and complicated subject matter. I'm not sure we're going to do it justice in answering the questions live, but about how it's calculated and some of the scenarios and assumptions. So Marcy is nodding yes, and so I'm hoping that we can provide those materials to our participants after when we send out the recording. And then we have another question around, again, sort of that nuance of how lowering the discount rate raises employer contributions, but theoretically lowers costs in the long run. Is that something that you could talk about?
Yeah, so when we lower the assumed rate of return, so we're lowering our view on how much money we can make in the markets. Those contributions have to come from somewhere. So there's three ways in which a pension is funded. It's the employer contribution, the employee contribution, and then those investment returns. So if the investment return lever is coming down a little bit from 7 to 6.8, it means the employer employee levers go up. It's probably the easiest way to describe how cost would impact contribution rates related to a discount rate change. There's just three levers, right? And the levers all have to, move almost opposite of one another, because 60% of the pension is funded through investment earnings. And if we expect to make less on our investments, then the contributions have to come either from the employer or the employee.
And one of the questions that I will be asking at the November board meeting is, for any change in the discount rate, what would be the financial impact for employers? And I've asked that question in the past, but I want to use up-to-date numbers instead of the old ones.
Right. I think that, Lisa, that was incredibly helpful to us as we considered the most recent change to the discount rate and how each 0.25% affected an employer contribution, just so folks can be beginning to study that. And I think the calculator really helps. And so again, encourage people to look at their actuarial reports, to look at and utilize, run some scenarios on the calculator. Call your actuary. We love our actuary. She is amazing. Spend quality time with your actuary, and they are ready, willing, and able to do that. And I think that we have answered all of the questions that I have seen come through the chat. And so I just want to personally thank you both for the time that you have spent with us today, and your thoughtful presentation and answers to our questions, and all of those folks who provided questions in the chat. Thank you for listening and processing and helping us, all of us, to understand. And we would like to turn it over to our Cal City CEO, Carolyn Coleman.
Wow, thank you, Lainey, for moderating today, and a special thank you to Marcy and to Lisa for joining us for today's program. Also to our president, Cindy Silva, for being with us today. I don't know about all of you, but I certainly learned a whole lot, and I do each time I listen to both Marcy and Lisa, as well as Lainey. If I think about this call, I think Lainey started us off by talking about the important fact that labor is one of the largest cost drivers for local governments, with pension costs being a significant portion of those costs. And because of that, I want to again acknowledge Councilmember Middleton for bringing the voice of public employers to the table at CalPERS. You all have heard me say in the past that if we're not at the table, we're on the menu. So it's so important to have her voice at the table. I also appreciate what both Marcy and Councilmember Middleton mentioned in terms of CalPERS' willingness to be more visible and available to city officials for frank conversations like this one regarding the challenges for CalPERS, as well as the important challenges for cities regarding pension sustainability. Throughout the call today, we heard about the performance of the fund over time. We know it is certainly in better shape than it was 5 years ago, but we still have room for improvement. An overriding question for Marcy and her team and the board is, what is the reasonable risk to accept to get a responsible rate of return? We talked about the three key risks to the system, besides investment returns, besides sustainability. It's employer affordability. And I certainly appreciate that Marcy and her team, and the time I've been working with them over the past several years, have, I think, sincerely recognized that. And also recognize, and you heard Marcy say today, that the sustainability of the system must include employer affordability as a primary consideration. We also heard from them about the efforts with the board to balance risk and reward, and that their work right now is understanding different asset classes and the various risks and returns associated with those. We also heard a lot about the drawdown risk and the importance of having a diversified portfolio so that you don't have to absorb all of that volatility that might happen in the market. We know that a lot of work is going on at CalPERS right now through the ALM cycle, and that there will be another opportunity, and there have been many over the past several months, another opportunity for stakeholders to engage directly in the process. You know, you think about what Marcy said at the end of the call today. CalPERS is a $470 billion investor in the market with over 2 million beneficiaries. And we as public employers, we're important shareholders in that process. So it is important that we use our voices and that we're heard as a part of this process. I appreciate that Lisa and Marcy are going to take a look at the agenda for the upcoming board meeting in November and try to help identify a specific time so that city officials and public employers who do want to be a voice and do want to be present at that meeting can get there and be heard. So lots to do. We as Cal Cities will continue to collaborate and work with Marcy and her team at CalPERS, as well as the board, to talk about a balanced approach to all of this. We recognize the importance of the sustainability of the system, but we also recognize that as cities, we have responsibilities to deliver essential services to our residents. So it's work to do it all, but I think that by having good conversations like today, we're in much better shape and prepared to engage than we would have been before. So thank all of you again for joining us. And until next time, stay safe, and thank you for all that you do to keep your communities moving forward. Have a great rest of your week.